You are listening to Investing Matters, brought to you in association with London South East. This is the show that provides informative, educational, and entertaining content from the world of investing. We do not give advice, so please do your own research.
Hello and welcome to this Investing Matters podcast. I'm your host, Peter Higgins. You can find me on X at Conquest3. Today I have the huge privilege of speaking with the writer, trader, musician, DJ, entrepreneur, financial educator, and former Wall Street trader, Jared Dillian, the author of 4 books, including the fantastic Harriman House recently published book, No Worries, How to Live a Stress-Free Financial Life, which we'll be speaking about later on in this particular podcast. However, I want to start with giving you a little bit of background on Jared. He is a master of market psychology and has been called the Dr. House of trading. And he has a following ranging from casual investors to professional traders and hedge fund managers. He has been a regular contributor at Bloomberg Opinion, Forbes, Street.com, and many other outlets. Jared is a frequent speaker at conferences. His appearances include MSNBC, Bloomberg TV, the New York Times, LA Times, Business Insider, and dozens of local and syndicated radio programs. Jared, welcome to the Investing Matters podcast, and thank you for agreeing to speak with me today.
Hey, thanks for having me. I appreciate it.
All right, Jared, I'd like to start this conversation, if I may, by firstly congratulating you on the absolutely huge positive impact you've had on the investing, financial, and personal finance lives of countless individuals across America and globally through your radio programs, newsletters, podcasts, books, and regular media appearances. You, sir, have been an immense education. That's why I wanted to speak to you today, because I believe that everyone should have a desire to improve their investing and their personal lives. This is why I do podcasts myself. I want to start, if I may, Jared, by asking you to please inform our listeners about your journey from Norwich, East Connecticut, not UK, to Norwich Free Academy, drum major, Coast Guard Academy, serving as a commissioned officer, serving as a spy, I believe as well, Coast Guard intelligence, to then stumbling upon your first financial book at the age of 23. Over to you, sir.
Yeah, I grew up in Norwich, Connecticut, graduated from high school in 1992. I went to the Coast Guard Academy, majored in math, actually, which is kind of funny because I'm a writer today, but majored in math in undergrad. I did take one writing class when I was in college, and that's when I got bit by the writing bug, and I decided I wanted to be a writer. When I graduated from college, I moved to Washington State, and there was one bookstore in town, and I was reading a bunch of short stories, and I called up my mom, and I said, Mom, I want to be a writer. I want to go and get my MFA and write short stories and be a professor somewhere. And she said, that is a terrible idea. You're not going to have any money. You're going to be poor. She says, you need to do something to make money. So I had a tangential interest in the markets. I was reading a lot of finance books, and I decided to go get my MBA. I went to the University of San Francisco, spent a little over a year on the floor of the Pacific Coast Options Exchange, and that was really my first exposure to markets. And then I was able to get a job at Lehman Brothers in New York City, where I did index arbitrage, and I was head of the ETF trading desk.
Okay, I want to go back just a little bit, because you jumped a little bit here. I want to go back to why you got so, to use an American phrase, pissed with one of the first books you ever read regarding the random walk down Wall Street. That's what triggered you. Tell us about that.
I read that book when I was in Washington State, got it from the bookstore, Burton Malkiel. I read that book, and I was like, there have got to be tens of thousands or hundreds of thousands of people working in the financial industry. Each one of them is trying to beat the market. You cannot tell me that they are all fools, right? Like, I knew I did not have the ability to explain why I felt the way I did, but I knew that this concept of market efficiency was wrong. And I basically said at that moment, I said, I want to disprove market efficiency. So I think, I've been in the markets for 25 years. I think the market is efficient in some respects and not in other respects. I think we've been able to demonstrate that there are a small group of people that are able to generate above normal returns over a long period of time, which I think disproves market efficiency. So I don't think I'm one of those people. But what I have done is, in the book, which we'll talk about later, I focus on risk-adjusted returns and how to build a portfolio that minimizes volatility. So,
Indeed. So I want to capture your essence here, and it's about when you were younger. It starts when you were younger, and there is a hunger, Jared, which I need to just get across to some of our listeners here, right? Because in order to get to the point where you got your first break, you were doing essentially 3 jobs, right? So I want to go back to that hunger that you had and just explain to people what you were doing, right? Because you were holding the job with the Coast Guard intelligence, you were studying part-time, you're also working on the trading floor. And I want to know also as well, how much sleep were you actually getting during that time, if any at all?
Yeah, so this was 1999, 2000. I was in business school. I was taking 2 or 3 classes a semester. I had a full-time job with the Coast Guard, working at Coast Guard Intelligence. And I also got a part-time job on the trading floor. So my typical day was I would get up at 3:45 in the morning, and I would head down to the trading floor. I would get there around 5 or 5:30, and I would work until noon. And then I would come back across the bay to my Coast Guard job, and I would work from about 1 until 10. And then I would go home and study until about 1:30 or 2 in the morning. And then I would sleep for about 2 hours, and then I would do it all over again. And I did that for about a year and a half. So
amazing. Kudos to you, mate. I mean, I'm looking at this and thinking about Lehman Brothers at the time and other, top tier sort of entities around America. And they're looking at all these Ivy League individuals, males and females, at the top 1 percentile individuals. And they're choosing Jared Dillian. Why? Hunger?
Well, I interviewed at a lot of banks, and my sales pitch was that I could outwork anybody else, that I would work harder than anybody else. And that wasn't well received a lot of places. A lot of banks didn't really care about that. It's not an accident that the one bank that did care about it was Lehman Brothers, which had a fantastically entrepreneurial culture and wanted people who were insane, who were willing to put in those hours. So, it's not a coincidence that they hired me. I was working in the right place. And, it was funny when I started at Lehman in the associate class, they took all our resumes and put them in a book. So there was about 80 of us in sales and trading and research, and we all had our resumes in the book. And when I got there, I was looking through that book, and I said, I have the worst resume in this class. I went to the worst schools, I had the worst grades, and yet I lasted longer than anyone in our associate class. I lasted all the way until the bankruptcy. There were 12 people hired in equities. After a couple years, I was the only one left, and I had a terrific career there. So,
fantastic, very, very well done, mate. Absolutely astonishing what you've done there. Right, I want to talk now about the Lehman times. Tell us about your time at Lehman's, the tasks, the promotions, earnings, lessons learned, and ambitions achieved during your time there, please, sir.
Well, I didn't get a great spot coming out of the training program. Like I said, I started working in index arbitrage, which was a business that was dying and becoming more automated and electronic. And we were doing it the old-fashioned way. We were doing it over the phone. So, and I'm not a computer science person. I wasn't capable of, building an automated system or anything like that. So I did that for 3 years, and I did well and made money. So I was asked to run the ETF desk. And when I started on the ETF desk, my boss said to me, he says, look, he's like, your job is not to trade. Your job is to market the business, right? So I said, well, how do you do that? Do you like take out commercials or billboards, or like how do you market an ETF business? So I started writing. I started writing market commentary on Bloomberg, which most of the time was really funny. I was trying to be humorous, but it was also serious. And over the course of the 4 years that I was doing that, I had thousands of people on my distribution list at the end. And when I took over the ETF desk, the revenues were 22 million, and when I left, they were 90 million. So I had grown the business, massively through really, which was a marketing effort just through my writing. So.
Fantastic. And that I'm led to believe that writing experience that you started then culminated in you considering then writing your first book, Street Freak, Money and Madness at Lehman Brothers. Is that what led to that?
Well, it led to me starting my newsletter business. It led to me starting the Daily Dirtnap. So what happened is while I was writing at Lehman, there was a young guy at the firm who was friends with a literary agent, and he was forwarding him my stuff. And the literary agent was like, oh my God, once Lehman went bankrupt, he said, we have to get this guy to write a book about Lehman. So I want to say in December of 2008, I went down to his office and he tried to convince me to write a book about Lehman. And I said, no. No, I'm not doing it. And then I went away, and 6 months later, he contacted me again. He's like, please, like, you have to write a book about Lehman. So I eventually did it, and that was Street Freak, and that came out in 2011. So.
Fantastic. So going back to your commentary for Bloomberg and your first sort of writing / marketing for Lehman's, I think I'll take this time now to just congratulate you on achieving your 20th year of financial commentary. Since you started in 2004 doing it at Lehman's, maybe around that sort of time.
Yeah.
Institutional customers and ETFs. So let me ask you this question then. 20 years on, Jared, from writing financial commentary and writing about ETFs, etc. Did you ever envisage that ETFs and Vanguard et al. Would ever become the global force that they are today?
Well, I didn't actually, because when I was doing ETFs at Lehman, ETFs were very different. They were thought of as trading vehicles, right? So they weren't really gathering assets. They were being used for short-term exposure. And Lehman in particular had really a hedge fund client base. So it was all short-term trading, and we didn't have really real money customers that were building large positions with these ETFs gathering assets. And that happened, I want to say, about 2009, after the financial crisis, that ETFs really started to gather assets. So I was really there in the early days before that happened.
Okie dokie. Well, I digressed a little bit then. I'm going to go back now and say this regarding your timeline. So, Jared, Lehman collapsed and you had the opportunity to join Barclays for what I'm led to believe, and what you stated before, is a 7-figure sum. And a recurring thing you keep talking about, which I love to death, is it's important to think big, right? Some people think £1 million salary per year, that's big. What happened next? What did you do next regarding the offer that was given to you by Barclays?
I turned it down. I decided I wanted to start my own business, start the newsletter. I did that for 2 reasons. Number one, I was really stressed out trading ETFs. I was really stressed out in my job. I was burned out is what I was. I was burned out. And second of all, I thought I could make more money long term with my newsletter business. And that actually turned out to be the case. I've been much more successful doing that, and I've had a lot more longevity than if I had stayed on Wall Street. So.
And I love the thing, you just touched on two vitally important things there. So you're stressed out and you're looking at your longevity, and you've actually had more longevity with regards to that decision you made back in 2008-9. Just for our audience here now, can we just firstly talk about the newsletter, Daily Dirtnap newsletter, and where it's taken you, what you've achieved, and the opportunities you've had because of that regarding going solo?
It's really, the financial newsletter business is a great business, and it's a lot of fun. It's a lot harder than people think. When I started in 2008, the criticism I was getting from people was, well, why would I pay for your stuff when I have the internet and I can get all this content for free? And that was in 2008, and that's even more true today. If you have a Twitter account, you can follow all kinds of people and get all kinds of great information. Like, why would you actually pay for research? So the challenge is to get people to pay for what you write. And it's really, really hard. It's really, really hard to get people to see the value in that, So I also have, now I have a lot more competition. When I started out, it was Dennis Gartman, it was James Grant, it was a couple of others, but I was one of really the first newsletters. And 16 years later, I have all kinds of competition, which is good, but it's, the business it's a lot tougher than it was when I started.
Okay, so whilst we're at this juncture then, just share with our listeners, where can they find your newsletter? Where can they subscribe to it, etc., please?
So the newsletter is called the Daily Dirtnap. You can go to dailydirtnap.com. And if you want to subscribe, basically I don't have an online form. You actually can't subscribe on the website. You have to send me an email. So send me an email and mention the podcast, and I'll give you a discount. So,
what, this podcast or your podcast?
This podcast.
Thank you very much. Now, Jared, we've taken that fantastic historical walk around your journey, and I just wanted to do that for our global Investing Matters audience to understand the significance and the value of the individual that they're listening to today. However, you're also a musician and a DJ, so I'd like to switch things up now, if I may. Please tell us when you started investing, followed by your current investing/trading philosophy, please.
So I started investing in 1998, I think, 98 or 99. I remember, and that's not true. I bought some mutual funds in 97, but I did my first stock trades in 99. I have always been a contrarian. So keep in mind, when I started investing in mutual funds, it was 1997, and everybody was investing in tech. And the mutual fund that I chose was the Dodge and Cox Stock Fund, which is an old value fund, right? And
wow,
that ended up over a 10-year period, like way outperforming all the tech funds there, because value really came back in 2002, and that ended up being the right trade. The first stock I ever bought was Philip Morris, which was right during the Engel case, during the master settlement agreement. And everybody, that they had a $252 billion judgment against them. Everybody thought they were going to go out of business. I bought the stock. It went up about 30 or 40% in 6 months, and then I sold it, and then it went up another 400% after that. So,
wow.
So I I tend to buy stuff that is really, really out of favor, like incredibly out of favor, like stuff that people say that you would be insane to buy, you know. I have a very contrarian philosophy. I have a very mean reverting philosophy. I'm not a trend follower. And, if there's a top or a bottom somewhere, I'm usually involved. So
we're definitely going to talk about your sentiment theories a bit later on. But first, I want to talk about this thing you just touched on there a little bit about your philosophy in trading, because you are known, Jared, on occasion to invest, then investigate. Please, can you explain that rationale for this approach for us, please? Because it makes sense to me now, having read it.
Well, a lot of people think that when they buy a stock or something, they have to do a lot of research, right? You have to do the research first, and then you buy the stock. Generally, the way information works, if you have good information, if you receive a piece of information, if somebody mentions, let me back up a second. So there's this whole theory of marketing that people need to hear about a product 6 times before they buy it. So if there's like a toothpaste, they see a commercial and it doesn't really register, then somebody mentions it to them. They're like, oh, I think I heard about that before. Then they read about it in the newspaper and they hear about something 6 times, and on the 6th time they finally buy it. The same is true for investments. The same is true for stocks. Except the problem is that maybe the first time you heard about it, the stock was at 20, and by the 6th time you heard about it, it was at 40, right? And if you had just pulled up a chart of the stock or looked at it or even did 30 seconds worth of research, you might have bought it the first time you heard about it. So when I get an interesting piece of information, I force myself to act on it immediately, right? Because that has value. So.
Brilliant. I love that idea. I'm going to have to try and build that into my my strategies going forward, because I tend to be one of those individuals that researches things almost to death. 100 hours later, I'm still pondering, and the share price has left me behind, as you say. Now, Jared, some of your fellow trading professionals are known to call you the sentiment king in calling tops and bottoms. A prime example being oil at peak near 130 per barrel and then falling 60% over 5 days is one example. Please, can you share with our listeners, firstly, how much does sentiment impact markets? And secondly, how do you measure this sentiment with regards to whether or not you're going to go very contrarian against what everyone else is saying?
Well, there's a lot of people that use fundamental analysis to invest, and I disagree with that. I think it's next to useless. I've never found any utility in it. You're looking at data that is stale and old and backward looking. Charts, technical analysis. I do some technical analysis, but you have everybody looking at the same charts. So the one strategy that I've found is repeatable over time is sentiment, right? Inevitably, in any stock, in any index, in any currency or bond or anything, people are overly enthusiastic on the highs and they're demoralized on the lows. And those are the points where you have to take positions, right? So, you mentioned oil. I think that was 2022, maybe early 2023. I can't remember. But what I was noticing was on Twitter, there was a lot of energy bulls that were just going bananas over the price of oil. They were so excited. And, you asked how I measure sentiment, and I don't have any quantitative way to measure it at all. It's all qualitative. I go on Twitter or I go online and I read what people are saying about it. A lot of it is looking at news and headlines and, magazine covers and stuff like that. Like, that's really what I pay attention to.
It's brilliant. Okay, well, I want to continue that conversation on, if I may. And you've touched on it there about market psychology, which is vital, and in order to get some clarity here. How do you personally go about reducing some of that noise that you might see on social, on various different platforms to optimize your decision making, Jared?
How do you reduce the noise? You kind of don't reduce the noise. You kind of live in the noise.
Oh, love that response. Thank you.
Yeah.
Cool. Mate, listen, I'm having that. I'm going to steal that one, by the way. Thank
Yeah.
you very much. Love it. Okay. So we've touched on it a little bit. You talked about sentiment there. Which aspects of investing trading really, really matter to you, including your dislikes here now, Jared, please?
Which aspects of trading, what do you matter to me, or?
Yeah, I mean, because obviously everybody wants to win, but there's a way of going about it in a sense of strategizing, thinking, risk reward, etc.
Well, the thing about using sentiment to trade is that you're you're getting involved in high probability setups. Okay. Um, that's really what I look for, like limited risk, high probability setups. I'm not, I'm not a trend follower. Like a lot of people, you'd have some chart going from the lower left to the upper right, and they buy the upper right hand corner of the chart. It's going up forever. I can't do that. Like, I buy stuff when it's down, when nobody wants it. So.
Brilliant. Love that. Love that. So you're a deep value investor. Can you reiterate to us as well this contrary thought that most people have? And you've stated this many times, which I love, because people do get carried away. And I think Nvidia is one of those stocks now, and Tesla the year before that. That no stock is safe. You caveat that with saying, however, large stocks tend to be safest. Please, can you expand on this and highlight the context of weightings regarding ETFs? Because everyone thinks, oh, just buy the S&P, it's safe, ETF, but the weighting on that is skewed now.
Yeah, I mean, I think it's 35 or 45% of the S&P is in 7 stocks now. There's a lot of
Around that.
idiosyncratic risk. I look in the United States, we have this weird idea that the stock market is safe and index funds are safe, and we're going to put all our whole nest egg, all our retirement money in the stock market. Nobody does this in any other country in the world, right? And it's a religion, it's a cult, it's a belief. People believe that stocks are going to go up 9% a year for the next 100 years because they went up 9% a year for the last 100 years, right? And the conditions that led to previous returns may not be present for future returns. There's no rule that says that stocks have to go up 9% a year in perpetuity, So when I look at the stock market, it is like it is dangerous. I mean, it's absolutely dangerous. And I don't know, like I just I want to be diversified across asset classes. Like that's the whole point. And when we talk about the book, we'll get into that. So.
Absolutely, we're gonna get to the books, but I'm gonna just touch on something here, which I've got to give you a shout out for this because I think it's absolutely fantastic that you continue to do this as well. What many people won't know, and I hope you don't mind me sharing this, you openly speak about traumas that have impacted you throughout your life, including some mental health, being a 9/11 survivor. And therefore, I find it absolutely inspiring to hear that you've done and you continue to do presentations in Wall Street to traders and investors there to aid them regarding their stress levels and mental health. Please, can you share some of the detail on that particular piece of work that you do and continue to do, please, Jared?
Yeah. I mean, I am very sympathetic to people who work in the financial industry because they and we all experience stress, but I think especially in the capital markets, the stress is higher than in other industries. And the most common types of things that people experience are depression and anxiety. And anxiety is really a big thing on a trading floor. it's not, a lot of people think of anxiety in terms of losing money. Losing money actually isn't necessarily the worst thing in the world. But there's big regulatory pressures, regulatory and compliance. There's so many rules that, there was a period of time when I was at Lehman when I thought that if I pushed the wrong button on my keyboard, I would go to jail. And that wasn't really far from the truth.
Wow.
There are so many ways you can make what is an innocent mistake and get in trouble and lose your career or worse. So these are the types of conditions that people are working under, and the anxiety and stress just gets to incredible levels. So yeah, I've talked to a lot of people on trading floors at banks about stress and anxiety and stuff like that. So.
Brilliant. And long way to that continue, really. You doing that work. It's a fantastic piece of work you're doing there, Jared. On that note then, Jared, what are the characteristics, traits and qualities of the most successful individuals that you've met and encountered whilst you were on Wall Street?
Three things. Intelligence. You have to be smart. That's a given. Number two is experience, which is funny because on Wall Street, people put a big emphasis on youth. They hire young people. And when people get to be about 47 years old, they are sort of pushed out and replaced by younger people. And that experience is really, really worth a lot. So intelligence, experience. But the third and most important thing is emotional fitness, right? Confident and happy people tend to be the most successful in investing. Neurotic, miserable people tend not to be successful in investing. So it's really about emotional fitness.
Indeed. I think we over in the UK, we use that reference about emotional intelligence and resilience. And I think you're absolutely spot on. Positivity, positive people, surrounding you with positive people aids success, I think. I think too many people are trying to undermine positive people a lot of the time. I love that reply. Now, Jared, given your time and experience of working on Wall Street and your continued interactions with people, there's always some sort of conspiracy theories going on and weird and wacky stories that permeates the corridors of Wall Street, including I think the one that I hear all the time regarding the US is the plunge protection team. Can you share one of those weird and wacky stories with us, please, that you want to share, please?
Oh man, it's actually gotten better. I would say 10 years ago, the number of conspiracy theories on Wall Street was just out of control. The plunge protection team, there is a president's working group on financial markets, which includes some big hedge funds and the CEOs of banks and stuff like that. And typically they'll convene that working group when markets are under stress. But somehow that morphed into this idea that there was a guy at the New York Fed in an office buying S&P futures, like propping the market up. There was a period of time, and this is like the mid-2010s, I don't know what was causing it, but every day the market would ramp into the close. And this went on for years.
Yes.
It would ramp into the close.
Yes.
And people said it was the government that was doing it. Like it was like the government buying the S&P, like buying stocks. I'm like, no, that's not happening.
Fantastic, and those stories are going to continue. Now, I'm going to ask you one very last question on the personal side of things. There seems to be and continues to be a rapid growth, Jared, of private equity funds across the US. In your view, what is this saying about the landscape of the investing market? And what does that say for the private equity landscape going forward?
There are 17,300 private equity funds. It's incredible.
Wow.
And actually, to put that in perspective, we've been through this before. We went through a hedge fund boom in the 2000s, right?
Yes.
And there were 16,000 hedge funds in the U.S., and a lot of them were very small. They were $20, $40 million hedge funds. And inevitably, it began to attract people that didn't have a lot of talent. It was a gold rush. It was a boom. And that fell apart, and there's been a lot of consolidation in, the hedge fund world. Private equity is really no different. Private equity made sense when interest rates were zero and you could buy companies for 4 or 5 times. Now interest rates are 5% and they're buying companies for 10 or 12 times. And there's no exits, there's no IPOs, there's not a lot of M&A. You have private equity firms selling to private equity firms. It's turning into a pyramid scheme. Like it's really bad. And what's going to happen is that, I think private equity has something like $3 trillion in assets, but they're buying up car washes and pizza places and stuff like that. And you're going to have these funds that are loaded with overpriced assets and no one to sell them to. And there's going to be a crash. So I think that's going to happen sometime in the next 2 years. It's difficult to express that in the stock market, but that is my belief about private equity.
Okie dokie. So with that consolidation and that overvaluation, is that going to be a shorting opportunity potentially going forward for some traders like yourself and your professional colleagues?
Oh yeah, absolutely. Yeah.
Cool. All right. We're now there. We've taken the long walk. We've done that. We've spoken about the random walk as well. I want to focus now on your brand new Harriman House published book, No Worries, How to Live a Stress-Free Financial Life. We'll start at the top here, Jared. And you're quoted as saying, financial independence, retire early, in brackets, FIRE, is a movement defined by frugality and extreme savings and investment. It's also a dumb philosophy. I love the fact that you've been bold enough to say that and to challenge the status quo and the austerity mantra that many subscribe to. Please, can you explain to me and our global audience why this is your view that FIRE is a dumb philosophy, please, sir?
Well, look, you can make the numbers work. I mean, if you save 70% of your income for 15 years, and you invest it and you retire and you get the returns that you think you're going to get, I'm not disagreeing with the math. Like the math checks out. Like it can work. Assuming you get those returns, right? Assuming you get those returns. But FIRE is an anti-consumption, anti-materialism movement, right? And what it says is that consumption is evil. We should not buy things. We should not spend money on things. We shouldn't consume anything. We shouldn't produce anything. We should merely exist, right? That's really what they're saying. And a lot of it has roots in environmentalism. They say we should not leave an impact on the planet, so we don't want to buy stuff that's going to end up in a landfill. And I actually have the opposite philosophy. I like to buy stuff, I am materialistic. I say that material things give us happiness, right? Buying something gives us happiness. So I think to live like an ascetic your entire life and to deny yourself that happiness is it's insanity, so that's my take on it.
No, I love that. So speaking of your happiness, and which is important, individually our happiness is important to all of us. You speak about buying stuff. So when you have done well in the markets, trading, or in life in general, how does Jared Dillian go about rewarding himself? What does he buy? What's the material thing he goes out and says, I'm having some of that?
Well, funny you mention, I had a pretty good Bitcoin trade back in 2019 to 2021. I got really big. I bought it at 10,000. I sold it at 41,000.
Wow.
And did really well. And I bought a Corvette. With it, But let me put it this way. I sold the Bitcoin before I bought the Corvette. I realized the profits, right? A lot of people, they buy something and they have a lot of unrealized gains. And then they start buying houses and cars and stuff like that. And they never sell. And then they have losses and then they're stuck, so.
Absolutely the right way to go about it, sir. Well done. Now, having done what I've done, trying to get into the right place with you, Jared, all I keep finding myself is going, I love that statement. I love that there. I feel like a bit of a fanboy, so apologies here now, okay? This statement of yours got me and gripped me. And you said here, we can all choose how much money we earn. Please, can you expand on that meaning, please?
Yeah, how much money is a choice. We all get to choose how much money we have, and I am choosing how much money I have. There are things I could do to make more money. Why am I not doing them? Well, because maybe it's too much work, or maybe I like my life the way it is, or maybe whatever, but money is a choice for everybody. If you want to become a teacher, that's terrific. I'm not like negative on being a teacher, but if you're being a teacher, going into it that you're not going to make very much money. So what you're saying is that money is not important to you, right? Something else is, whether it's working with kids or being an educator or, something like that. In the book, I think I said Jeff Bezos chose how much money he has, and Mother Teresa chose how much money she had, and everyone in between. We all get to choose, And by the way, even if you are a teacher, if money is important to you, there's things you can do to make money on the side, that a lot of people choose not to do. There's 24 hours in the day. We spend 8 hours sleeping. We spend 8 hours working. There's another 8 hours in the day that you can use to make money doing other stuff. You can start a business. You can be a landlord. You can get a different job. You can get a second job. You can work longer hours. There's a lot of things you can do.
Brilliant. I love that response, sir. Thank you very much. Now, given what you've written in the book, I just want you to without giving away, the secret sauce of the book, what are the greatest self-inflicted financial stresses that we impact on ourselves, Jared, in your view?
It's the usual stuff. I mean, generally people buy too big of a house. They buy too expensive of a car, and they spend a lot of money going to school that they don't have the ability to pay back. It's those three big things. Credit card debt for sure. Financial stress is also a choice. The funny thing is that while I was writing that book, I was in the process of building a very large house, right? And the house has caused me some financial stress. It was a choice. I didn't have to do that. It's a choice for everybody.
Fantastic. I love the honesty of that as well. Now, with regards to the recurring, you talked about building a house and it causing you personal stress as well. We have these, or see and hear, and on different programs all the while, this recurring debate regarding buying versus renting property as your home, and it's obviously a very personal choice that each of us make. However, I'd like to get your viewpoint purely on a very clinical financial standpoint, plus also ask you to talk about your rule of 150 regarding the long term, how things stack up best.
Well, buying a house is more expensive than renting about 90% of the time. Buying a house is almost always more expensive. And in the United States, it's a cult of homeownership. And the biggest, what I hear from people all the time, like people who are 27, 28, 29 years old, they're like, I don't feel like an adult because I'm still renting. Like, I want to own a house so I can feel like an adult. And I'm like, you don't have to feel like an adult. There's nothing wrong with renting. Renting is cheaper. If the air conditioner stops working, somebody will come and fix it. Like, it's really like there's no stigma associated with renting. But in the U.S., there is a stigma associated with renting. So people inevitably get pushed into these financial decisions to buy a house. And, people, what I say in the book is you should spend no more of 25% of your income on housing. And a lot of people are in situations where they're spending 45% of their income on housing. And what happens is it crowds out their ability to save and invest. If you have this extra cash flow that's going towards a house, I mean, some of it is investment, but it's crowding out your ability to save for retirement. So.
Brilliant. Love that response, Joe. Thank you very much. Now, what does investing diversification mean to you, Jared? How do you go about bringing down your investing risk, portfolio risk and volatility? Because you've got a fantastic example in your book, notably your awesome portfolio. I love the choice of name there as well.
So the awesome portfolio is 20% stocks, 20% bonds, 20% cash, 20% gold, and 20% real estate. And I started investigating this back in 2018. And what I noticed was, especially when you add gold and real estate to a portfolio, you are adding things that are not highly correlated to financial assets. You're adding real assets. And this brings down the volatility of the portfolio. So just, I ran the numbers on the awesome portfolio. Going back to 1971, which is the earliest you could have owned gold, the awesome portfolio has returned 8.1% a year with half the volatility of an 80-20 portfolio. And the biggest drawdown in any year has been 12%. Which was in 2022. So you think about this, you're like, I can make 8% in the awesome portfolio, or I can make 9% in the stock market. But I have half the volatility, and my worst year is down 12%. Like, where do I sign up for that? That's the silver bullet right there. That's the silver bullet of investing. So you're trading away 1% of returns, you're getting half the volatility. And drawdowns are very important, because drawdowns affect psychology. In 2008, the stock market was down 38%, and the awesome portfolio was down 9%. If you had the awesome portfolio in the financial crisis, you barely even felt it.
Fantastic. I love those examples. Thank you very much. Now, I need to just caveat what you just said there and ask you, how often would you then go about rebalancing the awesome portfolio, and when would trigger that for you?
Once a year. We rebalance it once a year, but I haven't done any work as to the optimal time of when to do it. I would just say rebalance it at the end of the year, on December 31st. But yeah, you rebalance it once a year.
Thank you very much. And you touched on there as well, Jared, and you speak about it in your book, about the often overlooked yet vital option value of cash. Please, can you explain what that means to you and what it should mean for others as well? Because there's this very UK, maybe European thing about, if you're invested, you should be all in investing, and it should be in stocks, and cash is just a wasted utility.
Yeah, it's the same thing in the U.S. Everybody wants to be fully invested. Cash is a big pile of opportunities, right? Let's just say you go on vacation, you're in Fort Lauderdale, and you see a real estate listing, and you're with your wife, and you're like, oh, let's look at this condo. And you see this condo, and it costs $600,000, and you're like, this is going to be our second home. We want this condo. You can do that right on the spot. If you have $120,000 in cash, you can just write a check for the down payment, and you don't even have to think about it. You don't have to sell stocks. You don't have to sell investments. You don't have to move money around. All you have to do is write a check. It could be a house. It could be a car. It could be a hedge fund. It could be maybe even private equity, which would be funny, but it could be private equity. It could be any opportunity. Your brother-in-law comes up to you and he is starting a business, like you can invest in that. There's going to be times in your life where you're going to get opportunities and you can't take advantage of them unless you have cash.
Brilliant. That goes, I feel like a DJ now. This just flows straight into the next beat I'm going to just lay down for you here now. When it comes to personal finance, why should people think bigger and maintain an abundance mindset? You've almost covered it there, Jared.
People should think bigger all the time. A lot of people, they make $60,000, $70,000 a year, and they think kind of, I make what I make, and that's pretty much it. I I always try to get people to think bigger. I'm doing this with my nephew right now. My nephew actually works on Wall Street, and he's focused on the next raise, the next bonus. And what I say to him, and I'm like, look, like, do you have any idea the amount of money that people around you are making? Like, think big, think long term. That's what I do. So.
Brilliant. Jared, I've almost concluded all my questions to you, but I want to ask this final question, if I may. You describe yourself as that warrior kid from Norwich, Connecticut. However, I suspect few from Norwich in the year of your birth has achieved as much as you have done, Jared. Okay? So bravo to you, sir. I think you're absolutely phenomenal. I would like to conclude our excellent chat with this final question. You've had many huge successes across Wall Street. You've written 4 books. We've only spoken about 2 of them. And you've grown the Daily Dirtnap into an institution. Please, can you tell us what you're most proud of? If you're looking back and speaking to that, warrior kid, Jared, at 14, 15, what are you most proud of telling him now?
I'm probably most proud of the books. So I've written Street Freak, which is a memoir about working at Lehman. I've written a novel, All the Evil of This World. I've written an essay collection, Those Bastards. I've written No Worries, which is nonfiction. I have another book coming out in November, which is called Night Moves, which is a short story collection. So if you think about this, I've written a memoir, a novel, an essay collection, nonfiction, and short stories in that order. Nobody has ever done this. Never been done. So that's what I'm most proud of. The books will outlive me. I'm a big fan of creating things that will outlive me and will just be available in perpetuity, where that's really going to be my legacy. The newsletter, it's a PDF. It goes to people's email. They'll delete it. It's transitory. It has a half-life basically, but the things that endure are the books, and that's what I'm most proud of. So I actually went back to school and got an MFA in creative writing from the Savannah College of Art Design. I did that last year. I graduated. And when I did that, I made a commitment to myself to write a book a year for the rest of my life. So.
Wow. Well, ladies and gents, the current book is this one. No Worries, How to Live a Stress-Free Financial Life by Jared Dillian. Please go out and buy this as soon as you can and ensure that you have a stress-free financial life. Jared Dillian, aka Dr. House of Trading, author of the brilliant book, No Worries. Thank you so much for sharing your fantastic insights and professional investing and trading experience with me on this Investing Matters podcast. Today from your home in Myrtle Beach, South Carolina. Take care, sir, and God bless you.
Thank you.
Thank you for taking the time to listen to Investing Matters. Be sure to check out the London South East website for free tools and info to research your next investment. You can also join in the conversation on our social media channels. And don't forget to subscribe to our YouTube channel for more content, including our CEO interviews. Catch you next time.